We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrivix. Joining me today is Lyn Alden, founder of Lyn Alden Investment Strategy. Lyn, thanks for joining me today. How are you?
I'm good. Thanks for having me back.
It's always great to have you, and we're going to, of course, do another deep dive with you today. I always look forward to getting to speak to brilliant minds like yours, and I thought we could kind of start by kind of conceptualizing and getting a sense of the world today by getting a grasp of a couple key concepts. The first being trade deficits. You know, we've been kind of berated by the idea of this trade deficit that the U.S. has right now since Trump's inauguration. So what does really the idea of a trade deficit mean right now?
So a trade deficit means that a country is importing more things than it's exporting. It's often thought of as in terms of goods, but it can also be services. For example, tourism is kind of a type of export. When people come to your country and spend money there, you're kind of exporting tourism services to them, right? Mm-hmm. So, but you can think of it as services, you can think of it as goods. But basically, when a country has a trade deficit, they are buying more than they're selling. And for the U.S., we have a really big goods deficit. We have a smaller surpluses, a service surplus, but the net result is a significant deficit. And unlike many countries, the U.S. has had this for decades straight. And so I would kind of describe like there's a couple different types of trade deficits. There's some years some countries are going to sell more than they buy, and other times they're going to buy more than they sell. These things come and go. Mm-hmm. There's also some countries that manage to have a structural trade deficit for a long time, but it's not necessarily detrimental because a lot of that trade deficit is going toward building the country out. Mm-hmm. The go-to example would be India. They've had a trade deficit for like 3 decades. One of the fastest growing economies in the world, and that's because that trade deficit is not primarily going to like overconsumption. It's basically going up to building up the country. So even though they're running these deficits, the economy is growing faster than the trade deficit is growing, and so it's actually pretty constructive. The U.S. has kind of a unique example, which we have decades of trade deficits, and it's primarily related to overconsumption rather than, say, a fast economic build. And what I've kind of established in the past with a number of articles, and I'm not the first one to point it out, is that the U.S.'s trade deficit is different than many other countries because it's directly tied to our global reserve currency. And what I mean by that is most currencies in the world, a country like a trader or an entity only accesses that currency if they kind of need to interact with that economy. Mm-hmm. Whether it's a rich country or a poor country. You know, if you're going to interact with Egypt's economy, you generally need Egyptian pounds. If you're going to access Canada's economy, you need Canadian dollars. And there's a handful of reserve currencies that are held for longer term savings, but not that many. And the dollar is by far and away the biggest reserve currency. And that's 4 primary functions. So 1, it's held as a reserve asset. 2, it's the unit of account for many international contracts. 3, it's on one side of 90% of currency trading pairs. So instead of, for example, trading Korean won for Egyptian pounds directly, that's usually not a very liquid market. You would trade one for the dollar and then the dollar for the other, because most currencies will have a liquid market with the dollar. And then also it's used for cross-border financing. So if an entity in Brazil wants to borrow from an entity in France, it'll often be in dollars, despite the fact that it's neither of their currencies, which creates inflexible demand for dollars to pay back those debts over time. And so the dollar has this excess demand associated with it that is totally distinct from any entities that want to engage with the U.S. economy. And that basically makes it so the dollar is kind of always perpetually overvalued on a trade balance basis, which gives us really strong importing power, which, as I mentioned before, can also include tourism. Like the fact that our dollar is strong means we can go to countries easier than they can come to us. We kind of get dollars out there. And then the net result is that it's pretty hard to manufacture things in the U.S. It's pretty expensive to do so, even compared to other developed countries. And when the whole world needs dollars and has trillions of them floating around, the question is, where do they get all those dollars? And the answer is decades of trade deficits is where they get them. So it's kind of like the other side of having the global reserve currency is running a big trade deficit to support it.
Well, I think one of the important kind of concepts there, especially in the example that you used about India, is this idea of let's call it the trade balance or the currency balance, having growth that's higher than the trade deficit. So does it always need to be larger? Does GDP always need to be larger than the deficit to be, let's say, sustainable, if we want to call it that word?
So on like a longer term basis, you'd want that. Yeah, if you have a trade deficit that's growing as a percentage of your economy, or
Mhm.
even just kind of treading water with it, you're kind of just pouring out more and more of something to the rest of the world. And then the question is what? And when the U.S. Ran on the Bretton Woods system, the limiting factor was that we were basically spilling out our gold to the rest of the world. We started that system with 20,000 tons of gold, and by the time that system broke, we had like eight or 9,000 tons because the number of dollars was proliferating, and they were ostensibly backed by dollars, backed by gold. And
Mhm.
so through the redemption process, literally in about a 12-year period, we just cut our gold reserves by more than half, and then they defaulted on that. The current system works in that we are basically exporting part of our industrial base every year. Uh, by countries whenever they want to build a new plant of some sort, they usually will build it elsewhere instead of the U.S. Whereas before decades ago, the marginal plant might have been built in the U.S. Now it's not. So both through new construction, it's usually built elsewhere, and then existing plants will often be they'll reach end of life. They'll be this kind of like stopped being invested in, and their replacement will be moved elsewhere. And so just because it's not competitive to do it here, just because of an overvalued currency. And so we have that kind of structural aspect to it. Whereas in India, their trade deficit will be like in energy and things like that. But then, they're building buildings, they're building industry, they're getting more educated as a population. You can't really look at that and say, are they worse off than 10, 20 years ago? By most metrics, certainly not. Whereas in the US, probably the median person, um, on like an economic basis, probably worse off than several years ago. There's many quantified ways to do that, which of course is then partially offset by technology. Everybody has a supercomputer in their pocket, which makes things more pleasant. But by a lot of kind of traditional metrics, it's been stagnant.
Mhm. And does the condition of having the reserve currency end up basically putting the US in a position where we're predisposed to have this overconsumption or malinvestment condition present within that economy? Or is it
So
is it more so chalked up to, let's say, mismanagement?
it's a rather mechanical thing
Mhm.
because if you want the whole world using your currency, they have to have a lot of your currency. They get it by overvaluing your currency and then basically forcing open your trade deficit and getting a lot of that currency. And then the US promoted it. We basically wanted our currency to be the global reserve currency, and we would kind of squash uh, kind of competitors that were, maybe competing around the margins to kind of keep it.
Mhm.
And there's a pro and a con. I mean, if you're the U.S. government, you generally like being the reserve currency because the world has a bigger appetite for your debt and your financial markets than it otherwise would. A strong dollar lets us have 700 military bases around the world. Wall Street likes it because basically what we're doing is we're kind of like selling like industrial stuff from like Michigan and to the rest of the world. And then they're getting all these dollars, and then they're reinvesting it into New York and Silicon Valley assets. So if you're in the dollar export business, as Luke Groman would call it, basically if you're in the financial security business, it's pretty good. If you're on the coast, it's pretty good. Whereas if you're anywhere in or near industrial centers, it's bad. Um, and so there's you could argue back in like the Cold War, it was probably really beneficial for the US to have the global reserve currency because we could print dollars to get oil rather than have to produce all of it ourselves or buy another currency and then buy oil with that. But really, in the past few decades, we've really been on the kind of the wrong side of it. So there's really no mechanical way to have the whole world use your currency if you don't have a lot of currency units out there, especially in the fiat-based system. Before the US had it, the UK had it, and they had the same problem. That was a different system back then because kind of ultimately gold really was the global reserve currency. But there still was that substantial overlay from um, the UK pound. And they had a similar issue. The US was the up-and-comer manufacturing nation. And the UK was this structural kind of trade deficit nation. And they were kind of stagnating first against Germany, and then against the rise of the US. So this is kind of a pattern that, at least in modern and kind of semi-modern history, has repeated and kind of mechanically has to, unless you have a more neutral system where there's not a single reserve currency, but there's a neutral reserve asset that is kind of at the centerpiece of the system. That's really the more balanced situation that could alleviate these structural imbalances.
So I'd like to kind of get to how the system is changing in a little bit, but Lyn, does the rest of the world being forced to use dollars, as you gave the great example of basically exchanging one fiat currency for another that there might not be a very liquid market in, needing to go through the dollar, does this give the US the ability to prolong this condition of overconsumption and malinvestment?
So for the first part, I would say that the whole world's not necessarily forced to use the dollar.
Mhm.
It's that it's got a very strong network effect. It's like kind of like
Right.
no one's forced to use Facebook, and for many younger generations, we don't. But if you're of a certain demographic, if you want to talk to your friend, it's often on Facebook. If I want to look up, financial social media, financial Twitter is by far the biggest place to be.
Mhm.
If I want to look up videos, I don't have to go to YouTube, but there's no second best really, right? So the dollar's the network effect winner in the world. And then yeah, there are also kind of dark histories of when countries maybe try to get off the dollar more deliberately, and then things don't work out for them, militarily or otherwise. So there is like also sometimes maybe some force,
Mhm.
but that combination of network effect and occasionally force puts them on it. And then when we kind of like look out further, um, the main question is, does it prolong the US like runway? I think that's actually one of the biggest issues, is it kind of like gives us more rope to hang ourselves with, in the sense that during the good phase, it seems like we're invincible.
Mhm.
Like, for example, Brazil their like market, their currency got sold off because of concerns around fiscal looseness. But their deficits, on a percentage basis, similar to the US deficit. It's just that there's way less appetite by foreign investors for Brazilian assets and currency. Whereas the US, because there's this kind of structural bid for US assets and by extension US currency, um, the US can run 7% of GDP deficits and people are talking about it, but no one's freaking out about it. And we could run decades of consecutive trade deficits. We can run structurally bigger fiscal deficits than, say, Europe has been comfortable doing. And this does give us a ton of power, which is why, for example, the political establishment likes it, and the kind of the corporate establishment likes it. The downside is that whenever there is finally kind of a reckoning, um, it's gone further than you otherwise think. Like an example I've used before is that if you were like a boxer and you had this rare condition where you didn't feel pain, that'd be really advantage for like the first several rounds of the fight, right?
Mhm.
That's a superpower. But it also means that you're like we have pain for a reason, because if something gets injured, we start favoring and protecting that more, and that boxer wouldn't have that signal. They'd be impervious to that, and so by later rounds, that would kind of that'd be a debt that they would have now,
Mhm.
and the U.S. kind of has that. We've kind of had the ability to deindustrialize ourselves more than many other countries would have by this stage, because we've really kind of blunt the impact for decades at a time.
Mhm. I I think that's a perfect analogy for it, and this basically this broken signal of your system not necessarily working anymore. But Lyn, when we combine that with the idea of the fiat currency system, why does this basically guarantee the perpetual growth of the amount of dollars?
Because of the way that fiat lending works. If we were in a more equity-based system, then you wouldn't really need a proliferation of currency units. But because we live in this kind of structural fractional reserve fiat currency debt-based system, basically most broad money is created by banks lending it into existence, fractional reserve lending.
Mhm.
And when they make a new loan, they basically create broad money, but then they don't create the interest that the loan receiver needs to pay back that loan. And on an individual loan basis, that's fine because, if they're successful in whatever they're borrowing for, they can get income from elsewhere. But when you look at it systemically, it basically means that there always needs to be like another round of bigger loans to cover the prior round of loans. So basically, that's why if you look at every fiat currency in the world, structurally speaking, they only grow up in units. You never see a flat or deep or deflationary fiat currency system. Whereas, for example, if you instead had a system that was say 90% equity and debt was used way more tactically, strategically, at a much smaller level, and everything was based on gold, it doesn't really matter how much gold you have as long as it's sufficiently divisible and all that, because the currency unit itself can strengthen over time. Prices can go down. But in the fiat currency system and as indebted as it is, it's kind of designed so that the units always have to go up. That's true inside of a country. And then also it's true for the reserve currency, the number of those units outside of the country. So they always need more dollars pretty much than they needed, say, 3 years ago, 5 years ago. And they get it by continued kind of to force open the trade deficit.
Mhm. So is that why the Fed is basically so worried about a deflationary condition?
I would treat that as well, the broad, not the reserve currency point, but the broader point that the way the fiat currency system works, yes. The fact that there's, yeah, I mean, in the US, for example, there's 102 trillion in liabilities, like loans and securities. That doesn't even count derivatives, just like, 102 trillion in debt. The base money supply is under 6 trillion. And then there's about 18 trillion in loans and securities in dollar-denominated debt outside of the country. That again doesn't include derivatives. So you're up to around 120 trillion in dollar-denominated debt on a monetary base of less than 6 trillion. So there's like $20 IOUs for every base dollar, which means that's basically a game of musical chairs. Another way to put it is not all sharks have this, but certain sharks, they have to keep swimming or they ironically drown. They don't get like water through their gills, and then they don't get the oxygen they need and they die. So they have to keep swimming. And a fiat currency system that's levered 20 to 1 is basically either a game of musical chairs that the music can never go off for more than a couple seconds, or the shark just has to keep swimming, and has to keep swimming faster and faster in this case. And that's not a global reserve currency specific problem. That's any highly indebted system has that issue.
Mhm.
Because if it starts to default, it's not like there's, twice as many claims as base dollars. There's 20 times. So if that were to completely unravel, every bank, the sovereign itself, it all kind of goes into like funny money. So that's why you never really see a major deflationary collapse when liabilities are printable. They'll always kind of resort to printing when things get really bad. And that's not like historically, it's not always been like that. That's really an era that we find ourselves in now, the fiat currency era, where we're more debt-based rather than more equity-based.
Mhm. Well, you're basically describing liquidity, right?
More or less. I mean, there's different definitions and ways to measure liquidity, but
Mhm.
basically, yeah, a velocity is a type of liquidity, which is you don't need that many dollars to keep servicing those dollar debts, but the dollars have to be able to kind of keep moving and going to wherever they're coming due at once,
Mhm.
right? So it's not like you need all, that most of that monetary base is that's why it's tiny compared to the number of debts. But as soon as it stops moving or even slows down substantially, that's when the music starts to slow down and the system starts to break.
Which we saw, in the fall of 2019 with the repo crisis, right?
Yeah, to some extent. That was a more
Mhm.
minor thing that was specifically in the US banking system. And that was basically tied to like liquidity requirements and things like that the banks had. A bigger example is probably March 2020. So, if the whole world's levered
Right.
20 to 1 and then you decide to shut down the global economy for X amount of time, those currency units, everybody's scrambling them for at once. They're not moving around the way that they were before. And so, for example, while that was happening, stocks, of course, were going down. At first, bonds were going up, meaning bond yields were going down. People were, of course, bidding for bonds.
Mhm.
But then at the worst part of it, bond yields started to shoot back up and the treasury market became illiquid. It kind of broke, especially off the run securities, which is it sounds wonky, but basically if they sell a 10-year bond, the government, that's an on the run security. 6 months later, that's like a 9.5 year bond. That's now a weird bond. It's not like a fresh bond anymore. So that's considered an off the run security, even though
Okay.
all it is a slightly aged, a slightly vintage 10-year treasury. Same thing for any other, not recent issuance. Um, those types of like 9.5 year or like 8.5 year 10-year treasuries or 4.5 year left on a 5-year treasury, those types of securities kind of just went no bid. The reason was because there were so many entities scrambling for dollars that they were willing to sell treasuries to get dollars.
Mhm.
And there's way fewer dollars than there were all the different IOUs for dollars. So that's why the Fed, they identified the issue. They had an emergency meeting. They came in. They did the fastest QE they've ever done. Um, they considered other measures too, and they basically they reliquified the market by creating a lot more base money.
Is this also the basis of the need for liquidity within the stock market too, Lyn? This idea that liquidity just keeps things moving.
To an extent, I mean, it's more critical for debt markets because they have a fixed maturity.
Mhm.
It's a contract that certain numbers of units are owed at a certain time. Now, if a stock market is sufficiently bubblicious, and some entities try to sell, they can find out pretty quickly that what they thought was a price is not a very liquid price.
Mhm.
It's kind of like how if you have a street and a house sells and all the other houses in that street now think that they're much more expensive now because
Mhm.
that whole house sold well. It doesn't mean that say five more of them could sell at that price necessarily. Same thing for stock markets. I mean, basically around the margins, you could have some selling pressure, but if the market turns from net buyers to net sellers, then you could get a liquidity unwind in that sense. So liquidity is important for kind of financial assets in general, but then it's particularly important for any sort of like obligatory security, which is loans and bonds, things like that.
Mhm. So going back to how this applies right now, Lyn, is the tariff model that Trump is introducing, is this breaking the dollar system as we know it?
I would say not yet because the U.S. kind of breaks alongside it when it's not handled well.
Mhm.
I think I would describe it as kind of misdiagnosing the problem, which is and it's a lot of these things are kind of based on partial truth. So, for example, there are a number of nations that are protectionist or mercantilist, meaning they'll try to put tariffs against importers while also trying to export as much as possible, and they'll kind of have these unfair trade practices. That's absolutely true.
Mhm.
And I think the issue is when that's considered the main problem, it misses the underlying problem, which is fundamentally, if the whole world's going to use your currency, how do you get currency units out there? And the answer is trade deficits. Um, and if you basically say we want the whole world to keep using dollars, but we don't want to give them dollars through trade deficits, that's where and it's already levered 20 to 1. So it's not like if you just kind of shut that off, you're gonna have a rough time. Not just the rest of the world's gonna have a rough time, but they have assets that they can sell to get dollars. They can sell your stocks, they can sell your bonds, um, to meet their liabilities. Um, and so that's the issue that is kind of ignoring the elephant in the room, which is that the trade deficit's a trade-off. It fuels our reserve currency, but also hollows out our industrial base.
Mhm.
So I do think that there is a mandate to rectify that imbalance. I think that imbalance has grown so severe. There's a reason it's become front and center politically in the U.S. But then the question is, how do you go about changing it? One is that because it took decades to build, it's not something that's going to change overnight. Even the process of just, building new manufacturing facilities and staffing them properly and building all the supply chains and logistics around them, that takes years, especially at scale.
Mhm.
And then in addition, there's all those dollar liabilities globally and all those dollar assets globally. And so there's kind of a trade-off that if you don't want to have trade deficits at the scale, you're kind of saying you don't really want to be the reserve currency anymore, or at least you don't want to be the only reserve currency. But that's not something that any country wants to kind of agree to or say out loud. Interestingly, Trump's chair of his Council of Economic Advisors, Stephen Myron, he wrote a paper that kind of touches on this pretty directly because that's
Mhm.
more written by an academic for academics, so it's a little bit more blunt in terms of kind of what it's talking about. But they basically talk about, ironically, trying to discourage the rest of the world from owning so many U.S. assets, which is kind of saying we want to be a little less of the reserve currency than we are now. Not necessarily to say we want to give it up, but we want to say, hey, maybe there could be other reserve currencies too. Maybe
Mhm.
we can elevate neutral reserve assets like gold and Bitcoin. Countries can hold more of those things, maybe less treasuries and less Mag 7 stocks, for example. Um, but then that somewhat conflicts with the administration saying we want to make sure there's no BRICS currency designed. We want to make sure that the dollar stays every bit of the reserve currency it is now, while trying to address our trade deficits. That's the challenge.
Well, certainly backing down the balance of the US dollar's dominance in the reserve currency or the trading currency of the world does leave a gap to be filled by another currency. But as you said, this also opens the door for those neutral reserve assets like gold and Bitcoin, right?
Yeah, and the funny thing is, the Stephen Myron paper directly talked about that.
Mhm.
Imagine 5 years ago hearing from the chair of the Council of Economic Advisors that a current approach by the administration would likely elevate, quote, gold and cryptocurrencies as neutral reserve assets. That'd be kind of the Overton window on these discussions have shifted.
Mhm.
And that's really kind of the long way out of this, which is to say, because people often ask, okay, if the dollar's not the reserve currency, then what is it going to be, China? And the
Mhm.
answer is, of course not, because one, there's no currency block or economy in the world that's as big as the U.S. was, relatively speaking, after World War II, when this was all kind of put together. So there's no country with over 40% of global GDP like the U.S. had, plus dominant military, plus the manufacturing base, plus so much of the gold. The U.S. had it all. Had this, basically every metric was off the charts. Um, and so that's you could build a reserve currency around that. Same thing for UK before then. Now the world's much more spread out economically. US and China are kind of similar economic sizes, some bigger than others in certain areas. Um, and a more multipolar world makes sense. And there's no, China's not big enough to be the global reserve currency. Europe's not big enough to be the global reserve currency. The US is no longer big enough to be the only global reserve currency. Basically, the imbalance has hurt us more than the benefits when trying to we're basically trying to be the ledger for this world that's like way bigger than just us.
Mhm.
And that the imbalances spill back up into us, which is deindustrializing our industrial base and pumping up our financial assets. And then everybody kind of gears around that. And the neutral way out is basically if countries hold more neutral reserve assets, and around the margins are a little bit more multipolar in the currencies they use. For example, if China it's able to use its currency more with its trading partners, not to say that it displaces like, the dollar in terms of like, reserves that, Canada's going to hold, for example, but when they're trading with Japan, when they're trading with multiple countries in Southeast Asia, when they're trading with certain countries in South America, around the margins, they can say, well, you can hold some of your reserves in our currency, and some of our contracts can be denominated in our currency. And instead of China lending to other currencies in dollars, they could lend some of it in their own currency. And so you have kind of an Eastern Bloc currency concentration, you have a European bloc currency concentration, which already exists, and then you have a US block combined with the neutral reserve assets that kind of tie that all together. Um, so if you start to have too much of one currency, you convert it to gold, or maybe in the future when Bitcoin's big enough. Right now, 2 trillion is not really big enough, but a big enough, liquid enough neutral reserve currency, neutral reserve asset that you can put your surpluses into that, and then that does not imbalance any one country in terms of trade.
Mhm. I like how you put that, and I think it's worth highlighting this idea of a neutral way out, right? This is, ideally we get to a point where this works for everyone, not just the US, not just creating conflict between partners. But on the other side of that, Lyn, when the US is implementing tariffs, what is the danger of retaliation from trading partners? We've seen China really capture markets like the rare earths, um, plenty of manufacturing. What kind of risks does that open you up to if you start to create conflict within those trading partners?
So I would say the initial risks probably come less from retaliation and more of kind of shooting ourselves in the foot, which is if we put tariffs on multiple things, it's not like we can snap our fingers and teleport those supply chains domestically. So we are taxing ourselves. We're taxing U.S. consumers and or the businesses that are operating with like Walmart has 4% operating margins. If their suppliers have a 10 or 20 or 30% tax placed on them, uh, they have to send most of that to the consumer, one way or another. For example. Um, and so because it takes years to relocate that stuff, and then when you do relocate it, it's more expensive where it's relocated to. So that's the first thing is just it has even if the other countries didn't impose any retaliatory tariffs, it just gives us our own challenges to deal with. But then two, when you layer on retaliation, so like China can make it harder for Apple to sell iPhones in China, for example. They can do that for tons of other products. Um, so to overall kind of trade slows down to some extent. And then in addition, there's non-trade things like you mentioned. Rare earths is one of them. They can kind of try to cover the market there. They already have a really big substantial position in that.
Mhm.
And it's not so much that rare earths are rare. It's often that they're environmentally destructive to get, and other countries have not really wanted to engage in that. So they kind of let China do it all, and now China has a pretty big lock on it. It's not trivial to kind of spin that up elsewhere. It takes time and money and bypassing not in my backyard, issues. And then two,
Especially, sorry, Lynn, especially on the refining and um, just being able to get it from the ore to production, right? Or to a
exactly,
raw
yeah.
product that manufacturers can use.
Yeah, the whole supply chain there, it's messy, it's hard.
Mhm.
And then the other part is financial warfare. So if it got bad enough that, China could say, well, we're gonna on a you know Monday morning just sell 50 billion in treasuries or 100 billion in treasuries to just kind
Mhm.
of render your market illiquid. And it's not the end of the world, but it kind of puts the US in an embarrassing position when that happens. You could, for example, have the central bank have to buy it to avoid the treasury market breaking, similar to March 2020 or similar to the UK gilt market in 2022, for
Mhm.
example. And that could potentially weaken the dollar to some extent. And there's other entities that can do it. Japan can do it. Taiwan can do it. There's multiple. A lot of them are Asian, but there's a lot of countries in the world that have firepower like that. Should trade negotiations get messy, and it can also push other blocks together. So, for example, early in May here, um, the Association of Southeast Asian Nations, the acronym is ASEAN, Asian. Um, and they have what's called Asian plus three. So it's these 10 Southeast Asian countries, but then when they expand it, they also include China, Japan, and South Korea. So East Asian nations, which together is a really big block.
Mhm.
They meet occasionally, so they met and they basically recommitted to pretty free trade among themselves, as well as kind of their own version of like the IMF, like a little mini IMF, where
Mhm.
if there's little trouble spots, they can do kind of targeted lending within their own kind of block. Um, and so it kind of creates a sense of unity sometimes between entities that are not otherwise the closest of friends in some cases.
Mhm. So then taking this out of the theoretical effect of let's say what China could do to the bond market if they chose to dump a bunch of bonds on the market, what effect has this actually had on the bond market since Trump's at least threats of the tariffs?
So one of the interesting ones is that when the U.S. stock market was performing poorly in that portion of April where it was, instead of the dollar and bonds being a safe haven,
Mhm.
we also saw bonds selling off, meaning yields going up, and we saw the dollar going down. You generally see that like in emerging markets, like it's basically capital outflows, um, rather than shifting from U.S. stocks to U.S. bonds. It was just like out of U.S. stocks into gold, to some extent into like emerging markets, and just kind of like not into other U.S. assets. Um, and again, that's like, at the numbers we're talking about. For example, if China decided to sell 100 billion in treasuries, um, that would be you'd have like a probably a market that looks kind of like what the UK gilt market looked like for a moment. Like you'd have this kind of like limit yields up, prices down, but then the Fed could just open a facility and just absorb that selling if it got bad enough.
Mhm.
And a lot of markets will kind of forget about it like a week later, in some sense. So these are disruptive, but they're not necessarily catastrophic, in a way that maybe many people try to sell the idea that it is.
Mhm. Well, certainly you wouldn't want to just from a self-interested standpoint, if China were to dump that many bonds on the market, they wouldn't necessarily want to do that without knowing that the Fed is going to come in and buy them, because they're not going to get as many dollars back for them. But on the other side of that, a slow bleed over time certainly brings the yield up and the price down, right?
Yeah, that's generally a smarter way to do it. Now, I mean, if you're a multi-trillion dollar economy and you want to send a signal, maybe you're t willing to take a loss on a multi ten billion dollar sale.
Mhm.
And I mean, it's like for example, when Japan was defending the yen, they didn't have like 100 billion sales, but they had these kind of like 10 plus billion moves where they would kind of like intervene at the tune of like 10 to 20 billion
Mhm.
at a time. And so, there's dislocations that can happen like that. But yeah, smart, and there's also self-interest, which is even if the goal is not necessarily to break the treasury market and kind of force the Fed to buy more of it, um, you could just not want a big enough percentage of your reserves to be like sanctionable or like confiscatable. You could just say, we think that a trillion dollars is too much. We want to go down to 500 billion over 3 years.
Mhm.
So we're just going to gradually, and you could do that through maturation. So for example, as bills, notes, and bonds mature, you can just say, yeah, we're gonna get our dollars back and then not reinvest them, and we're gonna buy gold or we're gonna make a loan to this other, BRICS country, Belt and Road Initiative country, um, and just do other things with those dollars.
Mhm. So then going back to the entire framework here of what Trump is trying to implement, what do you see as the ability of the US to fund its liabilities based on tariffs instead of, the idea that was thrown around about the federal income tax being backed down or cut completely? Is there an order of operations to how this could be implemented? And what do you think is the likelihood of the US actually being able to fund itself based on?
I think if you implemented something like that gradually, it'd be possible. If you basically said, okay, we're gonna have a 10% consumption tax, which is basically what a tariff is. And then we're gonna do a similar tax cut on incomes or other things. And we're gonna phase this in over a period of time. Uh, that can work mathematically.
Mhm.
That's certainly an option. Um, and then, that might be a tool in the tool chest for this. In practice, um, I keep pointing out that attempts at meaningfully closing the fiscal deficit in the U.S. Have a very high chance of failing. There's a number of reasons for that. One is they don't want to cut any of the major things. So they don't want to cut Social Security, they don't want to cut the military, and they don't want to cut Medicare. And they can't really cut interest expense, and they don't want to cut veterans benefits. And those things together are like over 80% of the spending. Um, and so it's kind of a third rail to cut any of the things that would need to be cut if you
Mhm.
want to do that. And then two, the U.S. is more financialized than most other economies. And so, for example, if let's say we just do a big tax hike, which is kind of what the tariffs are, um, as that kind of takes effect over months and quarters, um, that can impair the stock market, for example. It doesn't even have to go down. If the stock market just kind of goes sideways for a few years or even a couple years, that can actually start to impact tax receipts on capital gains, on income, on especially on executive compensation. Executives, they get paid in stock and stock options, and those stocks are no longer going up, so they have less tax to pay. And so we get income from one source, but then it helps diminish our income from another source, and we find that our deficits are still big.
Mhm.
And so it's quite a Gordian knot to untie, which is why I don't really expect it to be untied within, let's say, the next decade.
Then you mentioned this idea of backing the deficits down, and of course, um, Trump brought in Elon Musk and made the DOGE department, the Department of Government Efficiency here. So, what effect do you think that has had to help reduce the deficits? And is it going to be sustainable long term?
Well, so far the deficits are bigger this time this year than they were this time last year, overall. There's different estimates for how much they've saved. It's not a ton. I would say the biggest thing is optics. Um, USAID, that kind of stuff. It's mostly about optical wins.
Mhm,
It's not really going after the big money centers, Social
mhm,
Security, Medicare, and the GOP platform, the 2024 platform, directly in it had a promise for no cuts to Social Security, no cuts to Medicare, no increase in the retirement age. So the 2020s Republican Party is not the same as the 2010s kind of Paul Ryan era, austerity party. It's a shifting, you know, both major parties in the US have kind of shifted, what they look like 10 plus years ago.
mhm.
So there's really no fiscal conservative mainstream party currently. No appetite to really meaningfully reduce spending or meaningfully increase taxes. And then, like I said, even if they do those attempts, then you generally get weaker asset prices, and therefore you get kind of weaker tax receipts anyway. Um, and so it's not easy to untie, which is why as we look out 3 years, 5 years, 10 years, I don't think it's going to be very effective. DOGE even had, I mean, initially by July 4th, 2026, they wanted to be largely done. The initial executive order on January 20th that initiated DOGE listed 18 months as the expected duration of it. It authorized it for 18 months.
Mhm.
And they talked about that by mid 2026, which is the 250th anniversary of the US, they wanted to have the substantial cuts out of the way. And I think that they're not going to achieve that. Um, and I mean, they wanted to get deficits down to 3% of GDP. They wanted to trim deficits by $1 trillion. I think all of those big things are just not even going to, let alone reach it. I'm not even sure the direction's going to go down. But even if it does go down, I think it's like marginal rather than any sort of meaningful reductions in the fiscal deficit.
Mhm. Well, I mean, on one hand, I definitely think it's hard to argue that the cuts that they made and the wasteful spending that they found is a bad thing to get rid of. But on the other side of it, as it was sold, the optics of it, as you mentioned, it doesn't end up putting a real dent, a meaningful dent in the deficits. So,
Yeah.
Lyn, does this still lead us to something that you and I have talked about before, this condition of fiscal dominance, and maybe give us a quick refresher on the definition of that term?
So yeah, I do think we continue to be in a state of fiscal dominance. It's a bit of a spectrum. You can be in different levels of fiscal dominance. At the basic level, it kind of means that fiscal policies matter a lot more than monetary policies. And so, for example, running a 7% of GDP fiscal deficit is a bigger deal than whether the Fed cuts 50 basis points or doesn't, right? It's a much more impactful thing that's happening. And so I care more about what Congress is doing, what tariff numbers are, what the quarterly Treasury refinancing statements look like than I do, FOMC meetings. It's just kind of the world we live in. The deeper level of fiscal dominance is when the central bank, the monetary authority, some of their actions get constrained by what the fiscal authority is doing. Like they want to do one thing and then they can't because of the fiscal side, because they generally would never let their own sovereign default, for example. An example of this, for example, is the UK gilt crisis in 2022. The Bank of England literally had a meeting scheduled the next day about balance sheet reduction, which they had to cancel and go in and expand their balance sheet to buy bonds to prevent a market meltdown. Now, months later, they were able to get back to balance sheet reduction, but it wasn't on the timing that they wanted to because of this basically a fiscal issue.
Mhm.
And so you can have a case where um, deficits are too big. It's directly impacting the central bank's inflation targeting, and then two, it can also directly impact their ideal balance sheet size or their balance sheet growth rate, because they kind of have to keep their sovereign bond market liquid. And so you can kind of get gradual central bank capture, kind of by the fiscal authority, by the Treasury. And I think that's an ongoing issue. And I think by 2026, that's probably more in the highlight because right now, um, uh, it's not really a major issue now. And obviously, there's some tension between Trump and Powell. But by 2026, Powell's term ends, and a new Fed chair will likely be installed. And then by then, probably the Fed will also be going back to gradual balance sheet increases anyway, regardless of who's in charge. And so I think as we look longer into the future, you can kind of get less central bank independence. Japan's also a really good example of this. When they had like 4% inflation, they're kind of like, well, what are we going to do? Like we have 250% debt to GDP at the sovereign level.
Mhm.
If we raise interest rates, we blow out the deficit more than we put downward pressure on inflation. So, I mean, that's kind of why they were having currency issues during the heat of the inflation issue because Japan's firmly in fiscal dominance. The central bank is limited to what it can do just because of those fiscal constraints.
Well, and I mean, you see them just kind of running back and forth from side to side on that teeter totter of balancing the currency versus their bond market, right?
Yeah, I mean, so they have other strengths. I mean, everyone points to their weaknesses, which is poor demographics and, like 250% like sovereign debt to GDP. Those are obvious weaknesses. But then their strengths are that we talked about trade deficits. I mean, Japan's run decades of trade surpluses. They build up a big war chest of reserve assets.
Mhm.
And so they have the ammo to keep interest rates low despite bursts of inflation because if their currency weakness ever gets too disorderly, they can just say, well, here's a $20 billion defense of our currency. Oh, that didn't work. Here's another $20 billion defense of our currency. We just broke any short that got too leveraged. Oh, look, here's another 10 billion just for good measure. They have the ammo to do that because they've been very productive in the past,
Mm.
and they're still fairly productive as well, but especially in the past, and they kind of have that offset that they can benefit from, and that's true for a number of other pretty efficient East Asian nations.
Mhm. So then part of the strategy that was kind of introduced as part of Trump's plan was this idea that the dollar really needs to be lower to facilitate more trade, to perhaps incentivize manufacturing to come back. I think the jury might be out on the balance effect that has. But could the U.S. also devalue the dollar by printing dollars to buy gold as we move into this kind of, as you put it, this more neutral reserve asset era?
They could, yeah. I mean, that was discussed in the Stephen Myron paper. I also discussed that back in an article I wrote in 2020, um, which is and that's how like you'll see nations like Taiwan or Switzerland, they run these really big trade surpluses,
Mhm.
and they kind of prevent their currency from strengthening because they'll keep printing their currency and buying reserve assets with it, to kind of devalue their currency and build assets. Um, and generally speaking, when you look around the world, a lot of developed countries will have 5 to 10% of their GDP worth of reserve assets. Many developing countries will have 15% or more. Some of these really big surplus nations like Taiwan, it'll be comical with like over 100% like reserves to GDP. The US is the axiom of the system, and so we have like 2% of GDP worth of reserves, and it's mostly gold. We have very little anything outside of gold. So gold at not even the official price. If we kind of look at gold and the current market price, it's in the ballpark of like 2% of GDP. And that's really our reserve assets. Now, if the US wanted to get up to 5 to 10% like other developed nations, yeah, they could add trillions, a couple of trillion worth of reserve assets, and that could be gold, that could be other countries' bonds, like the rest of the world holds treasuries. They could buy other bonds, they could buy stocks, they could buy Bitcoin. There's any sort of reasonably liquid thing they can buy. There's obviously most of them have trade-offs, which is you're buying assets that get debased, you're buying assets that are confiscatable, or you're buying neutral reserve assets that you can hold yourself, with gold being the most liquid example.
Mhm.
Um, and so that's certainly an option. That's discussed by Stephen Myron. Um, the optics of that are not always great, especially if the U.S. did, it'd be kind of somewhat unprecedented. The easier way is to do a more multilateral devaluation, something like a Mar-a-Lago Accord,
Mhm.
which is obviously an echo of the Plaza Accord, if it were to occur, which is that instead of the U.S. doing it unilaterally, you can work with other major currency blocks to kind of do it on a more agreed upon basis, less just the U.S. kind of forcing it and just multiple entities kind of working together, buying and selling currencies to kind of release some of that pressure over time. And I don't think they would optically describe it as weakening the dollar. Like again, in like Stephen Myron's paper, they might because it's an academic kind of talking to other academics.
Mhm.
Um, I don't think optically this administration want to call it a weaker dollar. The phrasing is more like have other currencies trade at closer to their fair value or like not weaken their currencies. Kind of, it's kind of the opposite. It's like strengthening other currencies, but really what it means is kind of just getting back into somewhat closer to a balance.
Mhm. Do we by chance have any evidence, or is there a way to kind of figure out, Lyn, that the Treasury or the Fed was perhaps buying gold this year at the beginning of the year when we saw the LBMA timelines really blow out, where it was pointed towards, or let's say alleged, that people were just trying to beat the tariffs coming in. But is there any way of knowing if the Treasury or the Fed was buying gold to add to the 8,100-ish tons that we have already?
Well, the government would have to lie. They'd have to basically commit fraud on things that they publish like weekly or so, which is not the first time that would happen. I wouldn't treat that as a base case,
Mhm.
um, uh, just because it would likely be uncovered later, or there'd be very reputable entities inside it, kind of whistleblowing, I think.
Mhm.
Um, I do chalk that up more to tariff front running. Um, there can be other things behind the scenes, but overall, yeah, there's a reporting mechanism that should tell us. Um, I mean, this is, the Bitcoin proponent inside of me can't help but point out that most assets are not auditable. We don't know how much gold, officially refined gold, exists. We don't know. I mean, we kind of see statistics for how much dollars exist, but no one can just audit it unilaterally. Something like Bitcoin allows you to audit the whole network. You can say down to the decimal point, how many Bitcoins are there? Every 10 minutes, the number changes. But most assets you can't do that with, and that includes dollars, gold, and these other assets. So we have to kind of rely on the reporting that we have available and kind of, where possible, secondary sources to try to verify some of it. So, for example, sometimes people ask me, how can you verify the broad money supply? Um, well, I mean, the official sources will say it every week, but then technically you could go to every public bank's 10K, and see their quarterly numbers for like what are their deposits, for example, and you could piece together a big chunk of the broad money supply, just because I mean the top 10 banks are going to be a big percentage of it, and then
Mhm.
all the public banks together are going to be another big percentage of it. So if you ran a program to read all that, you could directionally figure out roughly what the number is. You
Mhm.
can't go into like every private credit union and little private bank, but you could probably get the 80% that matters. And so some of these things are auditable, but there are specialists that can dig into stuff like that.
Mhm. So, you mentioned buying Bitcoin. Where does the Bitcoin reserve come in at this point, and how would that be used?
I mean, that would just be like gold, with the exception that Bitcoin's a 10% of the size of the market of gold. It's more volatile. It's a 16-year-old asset rather than a multi-thousand-year-old asset. Um, and so, I mean, El Salvador has it as a sovereign asset. Kingdom of Bhutan, they have all this like stranded hydro. So they just built Bitcoin mines and held most of the Bitcoin that they mined. It's actually a really big percentage of their GDP now. I believe they have more than El Salvador, even though we always hear about El Salvador. Um, Abu Dhabi they have some like Bitcoin via ETF. They have some interest in like Bitcoin mining companies. So right now it's more usually at the sovereign wealth fund level rather than the central bank reserve asset level. Like it's not something they're intending to sell to backstop their currency.
Mhm.
So I think first we see it show up in things like sovereign wealth funds, and then only if it got much bigger and less volatile. If it 5x from here, for example, would you maybe see it start to show up in like central banks saying that, we're going to treat this like gold or treasuries, where if we want to backstop our currency, we can sell this. But right now, because it's volatile, it's treated more like an investment and
Mhm.
therefore ends up more in sovereign wealth funds, if at all.
Right. I was going to say, do you think that the quality of less volatility would need to be present in order for central banks to start really holding it in meaningful amounts?
I think it depends how forward-looking they are and how much career risk matters. So, for example, and this is true for companies as well, right? So, why was MicroStrategy able to kind of go all in on Bitcoin? Well, it's largely because the CEO was convinced on it, and he had the majority of voting rights. So he had a lot of
Right.
unilateral control.
Mhm.
Same thing, like there's tons of small companies, like small privately held businesses that own Bitcoin on the balance sheet because one or two or three founders can just decide to do it. Whereas if you're trying to get a company like Microsoft to do it, good luck, right? You're going through these layers of bureaucracy. No one's going to stick their neck out to make it happen. It's a $3 trillion company. Um, and most countries are more like Microsoft in that regard, which is if you're the one in the central bank that says, "Hey, let's buy Bitcoin," if it goes up a ton, if you manage to, if you one, you're going to be spending years convincing all your bosses to do it. Um, and if you somehow succeeded, which you're probably not going to,
Mhm.
and you buy it and it goes up, you're not going to get a bonus, or you'll get a pat on the back. Maybe you'll get maybe the best you'll get is a promotion or something. Whereas if they buy Bitcoin, it goes down, you can really get fired. So there's asymmetrical career risk. So it takes someone like, for example, Bukele of El Salvador. He's personally bullish. He had like 90% popularity. And so he's like, when he says we can buy Bitcoin, they're able to buy Bitcoin. Same thing with the Kingdom of Bhutan. Um, and so it generally takes a concentration of will to do it early. Now, then there's substantial benefits. Like MicroStrategy outperformed NVIDIA since they adopted their Bitcoin strategy. It's the best performing like large liquid stock in the world because they, kind of had the guts to do that. So they get kind of the early risks and the early rewards, and that's at the sovereign level too. Um, but generally speaking, you'll see smaller, scrappier entities do that, and the bigger ones come in later or not at all.
Mhm. So Lyn, what what effect do you think the tariffs are going to have on inflation? What are the inflationary, the downstream inflationary effects of these tariffs, and what assets work well in that environment?
So I view it as uneven impacts on inflation. So generally speaking, sustained price inflation comes from a sustained increase in the money supply. Uh, because if you don't have a higher than normal increase in the money supply and you get certain prices go up, generally what happens is that consumers have to spend less elsewhere. So you'll
Mhm.
get disinflation in some discretionary categories to buy the things that went up in like mandatory categories. So for example, like Walmart are already announced that they're going to be increasing prices. So generally speaking, for things we import from China, we should expect price inflation. But that could also mean companies are pinching pennies on salaries, so people aren't getting as good wages. Or if people are, they're finding that their bill at Walmart is bigger, um, maybe they're getting haircuts less frequently, right? So like a barber has to kind of discount their haircutting service. I mean, I'm picking a funny example, but the point is things that they can push out or try to seek a bargain on more, they're probably going to do that because it's not supported by a great increase in the money supply, like we saw during, for example, COVID stimulus. So I would expect inflationary in some areas, disinflation in other areas, and a pretty mixed bag, and then it shows up more in pockets of economic weakness or pockets of economic uncertainty and pausing until there's clarity.
Mhm. So then are we likely to just go into an environment where these neutral assets that we've talked about are the ones that end up performing best because of the other countries moving into that area?
I think we've already seen that. I mean, there's somewhat of a shift starting in 2009. So for decades, global central bank gold tonnage was on the gradual decline, and that bottomed in 2009 and has been going up since then. And then it got a little acceleration, from like US and Europe, kind of sanctioning Russian assets because of their invasion. And so there's multiple entities in the world that say, well, maybe we want to have some of our reserve assets in our own custody more than we did before. So we saw, for example, Germany did repatriation of some of their gold. Other countries have done some repatriation. There's generally around the margins, central banks are buying more gold than treasuries overall. And so I think that's already started. And I think that trend is now kind of increasingly known. And these things tend to move slowly, like career risk we just talked about. But yeah, I think that there's a general trend toward neutral reserve assets and then combined with some degree of asset diversification. So it's not like dump all your treasuries and buy a ton of Chinese bonds. But around the margins, you say, well, maybe we'll trim this by 1% and we'll add 1% Chinese bonds, and then we'll make it 2%, for example. And you go from zero to some non-trivial number over time. So combination of neutral reserve assets and a little bit of diversification.
Mhm. Excellent. Lyn, I always appreciate getting to spend some time with you and really pick your brain on all of these very esoteric economic subjects. Is there anything that you'd like to leave our listeners with to think about before we wrap up here today?
I think we covered most things. I think it'd be important to watch. I would say going forward, it's certainly more important to watch fiscal issues than monetary issues. It's not to say that monetary issues are not important. So interest rates matter. What the Fed's doing with their balance sheet matters. But anything related to increased or shrinkage of fiscal deficits in the U.S. Matters both to the U.S. and globally more than fairly minor monetary changes. I would say the same is true for China. When they say, "Oh, we announced stimulus, we're going to trim, key interest rate by 50 basis points," that's a somewhat ignorable headline. Whereas if they come out and say, "Hey, we're going to spend the equivalent of $500 billion on consumer stimulus," that's a much bigger deal. So I would say we're certainly in a world where fiscal matters more than monetary, from an investor point of view or an economic point of view.
Right. So for those that want to read more of Lyn's work, that's all available at lynalden.com. Of course, on Twitter at Lyn Alden Contact, and of course, Noster, right?
Yes. Decentralized social media.
Perfect. Lyn, always a pleasure. Thank you so much for your time today.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.